So in that, we are going to go probably 30-40 minutes here with kind of a dialogue with Mark. He's got over 29 years of experience in the investment business. He is the Director of Investment Strategy and Education at BlackRock. We are fortunate to have him here. His main job is to help interpret the nerd data behind the scenes at BlackRock into terms that we can understand and make decisions with. So we're excited to have him. I will turn it over to him and we will get started. And Nicola, don't want to miss you. She is also with BlackRock and it's kind of a liaison for us at BlackRock. So Mark, go ahead and take it away. You're on mute. We got you muted still.
Sorry about that, Ian. Good afternoon, everybody. You'd think I'd figure out that mute button by now.
No worries.
But thanks for having us on your call today to talk a little bit about what's going on in the market. I'll try to share my screen again here. Certainly no shortage of content, right? Given the first half of the year has been a struggle, right? Both of the stock and the bond side, certainly a lot of concerns checked off. You think about all the concerns we have, right? Russia, Ukraine, inflation, right? Certainly at high levels. Certainly the market volatility, both on the stock and the bond side. Recession has popped up as a word, right? The Federal Reserve raising short-term interest rates in general, going up to levels we haven't seen in many years. And certainly COVID's still lingering, both here in the States and globally. So feel like we have all the concerns checked off here in 2022. We'll try to address a handful of those. We won't be able to get to them all, but we'll try to address some of the things that we're seeing both in the market and the economy. Pretty historic period without question. And I think that does create some opportunity. So we'll lean on history quite a bit. We'll look at our student of the market piece, which is something that we do monthly, send it out to advisors across the country. And we often lean a lot on history. You'll see that. It's the old Mark Twain, history doesn't repeat, but it often rhymes. So I think it creates a good foundation of knowledge for folks just to better understand how things might unfold. Everything's always a little bit different, right? Each time is different, but the way the market reacts, the way the way investors react, even the way the economy reacts can be similar to history. So I think it's always a good base of foundation. So we'll do that today. As Ian said, we'll probably go about 25-30 minutes here. So we'll certainly have time for questions. I'm kind of a chart and graph guy, so I apologize up front. Bear with me. I'll try to bring some of these to life as much as possible. And we'll dive right into July here. And I think one of the things to start with is just the historical context of the performance of both bonds and stocks so far this year. You can see on the left side, we'll start with bonds. Bonds are down about 10.5%, 10.4%. We're pretty similar even through last night. And it is by far the worst start for bonds in history, going back 95 years. So if we go back to 1926, it is the worst start by bonds to begin a calendar year, and by a pretty wide margin too. It's not just the worst start to the year, it's a worst start to the year by a pretty healthy amount. You can see only 1994 was second, so it was down about 3.9%. So you can see we're well past that start to the year. And then you can see some of the other years as well. 94, I think, is interesting just because it was a similar period where you had the Federal Reserve raising short-term interest rates fairly aggressively, and that certainly has contributed to the losses. Trying to rein in inflation, right, is what the Federal Reserve is trying to do. And it's led to losses in the bonds on the short term. And you can see what happened the next 6 months in some of these periods. All these periods are positive, actually, the next 6 months. Granted, some of these, especially the ones with the big returns, were periods where interest rates were much higher than they are today. So clearly, you could have just collected the income off your bonds in that second half of the year and produced a nice big return. But I thought it was encouraging that generally had positive returns in each of these worst starts to calendar years for bonds in history. Again, going back 90, 95 plus years. On the right side is the stock story, not much better, unfortunately. For stocks, they're down about 20% through the end of June. We're right around 17% through last night. So we've gotten a little bit back. But you can see only 1932 and 1962 were worse for stocks to start a year. Something about years that end in two, right? Don't seem to work out real well. 2002 is on here as well. But you can see some of these worst starts of the year. You actually had a really big second half of the year, 1932, 62, 1970 as well. Even down to 1939, you had pretty big second half of the year for stocks. So I thought that was encouraging. Granted, some of the years towards the bottom, 2002, 2008, more recently, was a little bit more challenging, right? Where you were lower the second half of the year as well. Granted, those were pretty significant recessions and bear markets. 73, 74 as well was a pretty significant recession and bear market as well. So thought it was helpful to look at that historical context, just how unique and unusual it is for both stocks and bonds to be down as much as they are to start the year. I can tell you, when you look at full calendar years, there's only two full calendar years in that 95 years of history in which stocks and bonds both lost money in the same calendar year. It actually happened in 1931 and 1969. So to go a full calendar year in which both stocks and bonds lose money is pretty rare. So I think, when we look at this, certainly no guarantees, but I think there's a good chance that bonds especially start to claw back some of these losses. Whenever you see something that's this big of a historical outlier, right, it tends to swing back the other way. Think about the markets just being a pendulum, right? You'll have it swing one direction, it'll swing back the other direction to a similar amount. I really think bonds are poised to do that in the second half of the year. Again, the reason for the loss is the Federal Reserve raising short-term interest rates pretty aggressively to try to fight inflation and rein in inflation. And that's one way to do it, to try to slow the economy, slow down inflation. And the market's priced in a lot of action by the Federal Reserve. So more than what they've already done, priced in a lot of moves between now and year end. Certainly, we're not sure that they're going to be able to do all of that between now and year end. It's going to result in slowing the economy in a big way. Really, when you raise short-term interest rates, when you raise interest rates in general, it acts as a brake on the economy, right? It just makes everything a little bit more expensive, from financing a home or financing a business or car purchase. Everything becomes a little bit more expensive when interest rates go up. So we think that's going to be difficult, really, to do that and not do some damage to the economy. I think that's the concern the stock market has as well, is that the Federal Reserve might raise short-term interest rates too far, too fast, and really push us into a recession. We don't see that in 2022. Potentially in 2023, certainly the odds of that recession have gone up, especially if the Federal Reserve does move too far, too fast. But there is still some health to the economy, right? The job market's still really good. There's twice as many job openings as there are unemployed folks out there. So there's a lot of good fundamentals to the economy that we think will help absorb some of those interest rates. But clearly the economy is slowing from where we were when we went to a more durable restart of the economy across the country. And I think about it as a car. If you have a slowing car and it's clearly slowing down, and then you jam on the brake, you're going to come to an abrupt stop. And I think that's what everyone hopes that the Federal Reserve avoids, but certainly that potential is there to really stop the economy in a more aggressive way that certainly would not be healthy as well. So that's the challenge. Certainly historic start to the year. Again, whenever you see some of these historical outliers, I do think it creates some opportunity to put money to work. I think in the short term, right, certainly on the bond side, that makes sense. I think always, if you can buy stocks down 20%, right, 20% off where they were to begin the year, that always is a good opportunity as well. And volatility has been a big part of the story for the stock market, especially. This is a chart that we use to really look at volatility, just how much the market moves up or down on a given day. So if you can see on this chart, we've got the number of days in which the stock market's moved up or down 2%, either on the plus side or on the negative side. So any 2% movement up or down we count that. We had one yesterday. Actually, we had a 2% positive day yesterday. So we're now up to 27 days so far this year that we've had a 2% move. And you can see that's completely different from where we were last year, right? We had 7 all of last year, much more similar to the pace that we saw in 2020, right? When we had 44 days that were plus or minus 2%. We're really similar pace there, but not near the level that we saw in 2008 when we had 72 days during the global financial crisis, the housing bubble bursting. You can see we had 72 back in 2008. There's about 250 trading days in a year. So 72 days, that's one every 3 or 4 days we were getting a 2% move. And it probably felt that way, right? Back in the global financial crisis. So clearly we're elevated from a volatility standpoint. One connection I always try to draw here is if you look at the periods with a lot of 2% trading days, a lot of volatility, it's always around economic uncertainty. It's always the stock market trying to digest where the economy is headed. There's a lot of uncertainty on where it might be headed going forward. That's always when you see a lot of these 2% days. And, whether it's 2020, right? And most of that happened in the first half of the year as the pandemic and the shutdowns were setting in, or the global financial crisis, right, back in 2008. Or even back when the tech bubble burst, right, in 2002, post 9/11, a lot of uncertainty about where the economy was headed. So I just thought that was helpful to really draw that connection between a volatile stock market and the fact that it's economic uncertainty that the market's struggling with, right? Trying to figure out where we're headed with the economy. And obviously that's been a struggle really since the pandemic started, right? Obviously a lot of challenges with inflation, Russia, Ukraine. We talked about the laundry list of concerns. A lot of those are about the economy and where we're headed. Stepping ahead, we're entering midterm election.
Can I jump in real quick with
Yeah, absolutely, please.
a question that rolled in? And also, it sounds like something's been going on with the chat feature. It doesn't work for some reason. So we're working on problem solving it. But if you can see that in the chat session, there's an email address there, amber@ricefg.com. If you send your questions to her, she'll send them over to me and we'll get it going. So apologies for that, but that will work to email her. And then a question that rolled through real quick for you, Mark. With interest rates continuing to increase, when do you think it is attractive to start investing in bonds again? You said it might have better performance through the rest of the year. I have a couple other questions, but I'm going to save those. But
yeah,
when do you think that if we've pivoted away from bonds a little bit, when do you think it's time to reconsider, depending on how much you see the Fed playing with rates and the impact there?
Yeah, no, good thought. Clearly, I think now's a good time to start looking at it, right? It's always hard to time it perfectly, especially with interest rates are tough to call perfectly. But I think, we've reset interest rates back to such a healthier level than we were a couple of years ago. Think about during the pandemic, during 2020, interest rates got to as low as 0.5% on a U.S. 10-year Treasury bond, right? So less than 1%. We were right around 0.5% on a 10-year U.S. Treasury bond. We're now at 3%. And that's so much healthier because more income, more equals more return for bonds going forward. It's just such a healthier level for portfolios and investors. So I think it's a good time to look at both taxable and tax-free bonds out there, right? Incomes are at a much healthier level. Trying to figure out exactly when interest rates will stop going up is very difficult. But we've been right around this 3% range now for several weeks. So I think it's a comfortable level at this point, right? Even if rates continue to go up a little bit higher, right? You're earning enough income at this point to offset some of that loss. So in the short term, I just think longer term, it makes some sense if you have some money to put to work to take advantage of higher interest rates at this point, especially given the fact that inflation's as high as it is, right? 9.1% inflation, right? There's really no other way to battle high inflation, to stay invested, have a well-diversified portfolio that probably includes some bonds, right, at these levels. So I think it's probably a good time to think about putting that money to work because sitting on the sidelines in cash might look good so far because stocks and bonds are down year to date. But the problem is inflation's still 9%, and going forward, right, losing out to 9% inflation, it doesn't take you long to dig yourself a little bit of a hole there and erode some purchasing power.
So so kind of reading between the lines on that, do you guys, with how much the interest rates have come up and the adjustments they've made already up to that 3-ish% range, it sounds like you don't anticipate them going up that amount again. They might go up a little bit more, but you don't anticipate like another doubling of interest rates from where we're at now.
Yeah, no, I think it'll be really difficult, right? Again, think about higher interest rates just being that break to the economy, right? We've gone from less than 1% to 3%. It'll take the economy some time to digest that, right? And reset levels. The fact that, right, more you're seeing in the housing market has slowed tremendously already.
Yeah.
Just given the fact how much more it costs to finance a new home purchase, right? Or you don't have that luxury of refinancing your home to make your cost of housing cheaper. So all those things take a little time for the economy to digest. But I think it's just very difficult right then to see interest rates go even higher because, right, you're already breaking the economy fairly significantly. So yeah, I think if you're concerned about that, maybe a shorter term bond fund would be a place to go, because I think that's the nice thing. Short-term interest rates have come up quite a bit. So you can reduce some of that risk that if interest rates do go higher, you can buy a shorter term bond fund that'll give you some protection against higher interest rates, but still give you a pretty healthy yield compared to where we've been in recent years.
Cool. Thank you.
Moving on, just back to the slides, we're moving into that midterm election season, which generally isn't great for stocks. I thought this was interesting. We broke out all the calendar years by, where you're at in the election cycle. And midterm election years, right, is the second year of a term of a president, right, where you have Senate and House seats up for grabs. And you can see midterm election years are well below average for stocks, 8.6% historically, which is actually a pretty big gap between that and the average. But I thought was more interesting, look at the right side. For whatever reason, these election years, the first half of these election years, we broke it into the first 6 and last 6 months of the year. The first 6 months of the year are always pretty bad for stocks, or at least pretty flat returns, whether it's a presidential election year or these midterm election years, especially. For whatever reason, stock returns are really low in that environment. But the second half of the year is actually really good. And then if you look on the far right, those non-election years, the first half of the year, it's actually reverse, right? Where the first half of the year is really good, second half of the year is more not quite as good. So I thought that was interesting, and certainly, hopefully, we see this play out this year, where the second half of the year is better. But I just thought that was a ray of sunshine. Hopefully, if this holds true, where we can get back some of those losses we've seen in stocks, because that's what the historical trend has been in these midterm election years and election years in general. I think by the time you get closer to the elections, maybe some of that uncertainty starts to wane, right, as far as what the direction is politically. And the market can, again, digest what the implications might be for the market and the economy going forward. So I thought that was interesting. I know we're going to start to see all these commercials, and certainly seeing a ton of these political signs up in Arizona, which is always an eyesore. Moving on to stocks, just over the longer term, right, beyond just the rest of this calendar year, we updated this chart. This goes back to 1926 again, so 96 years of history. You can see if you had $1,000 back in 1926 and you invested that in U.S. stocks, it grew to over 11 million, right? So think about that, $1,000 growing to over 11 million. Not too sure how many people had $1,000 back in 1926. But you can see all the bear and bull markets highlighted on this page. And we didn't even highlight all the historical events here because it would get too cluttered, right? With all the wars, assassinations, right? Global pandemic we could add on here, all the challenges that we've had as an economy. And the markets had amazing resilience and perseverance over time, right? I think that's really the story here. And you can get a feel for how long some of these bear markets lasted, right? How long it took to recover, right? Most recently, the one back in the global financial crisis was pretty significant historically. right, where you're down over 50%, lasted almost a year and a half. But I thought it was good just to understand and remind ourselves just how resilient the stock market's been historically. Again, you look back at some of these corrections and bear markets, it's been always a good time to invest, right? When the market's down, you can buy stocks on sale. Again, very tough to figure out exactly what will be the bottom in stocks. We could have already put it in place here at the end of June, right? But the resilience is hard to ignore here.
So Mark, real quick question on this. We've seen a lot of people comparing kind of like the world scene right now, both political and social and other stuff like that, to like the 60s, 70s. What are your guys' thoughts on that? Kind of the rhyming history from interest rates and scenarios. What are your thoughts on that?
Yeah, I think that's a good point, right? I think you see elements in a lot of these different periods, right? I see a little tech bubble too, right? Where we saw technology lead the way for so long, where a lot of those companies were pretty expensive and really dominated a lot of stock market performance for many years, but not nearly to the extreme of the tech bubble. And you're right? You could bring back the 70s and 80s because you had really high inflation in those periods, right? So there's elements of a lot of these different periods that I think are similar. I do think the economy's on better footing than a lot of those periods, especially the last two, the tech bubble and the global financial crisis. Even if we do get a recession, and we'll touch on it a little bit, we do think it'll be much less severe. Again, because folks just haven't spent money like they normally would, right? During the pandemic, and travel, didn't go out to eat as much. So fundamentally, I think the economy is in a much better place. I think we're in a better place than even back in the 70s, right? 73, 74 was a really challenging period. I think fundamentally we're just in a better place, but you can see elements in a lot of those. I think it's a great point, but it's not completely one or the other. And it's different than what we saw in 08, 09, when you had a lot of stress on the financial system, right? With the housing bubble bursting, really trickled through to a lot of the financial companies. So very different than where we're at today, much better fundamentals. So I think that's a positive, right, for stocks in the near and long term.
So question kind of follow up to that, with where we're at now, like so much of the like world media and everything makes us want to freak out, and like we think like whatever's going to happen is going to get worse and stay worse forever. Like it's never going to be the same, the doom and gloom. What are your thoughts on like how, like where gas prices will be, inflation, stuff like that in the next year?
Yeah, no, I'm a little bit of an inflation geek, so you're getting me going on my inflation soapbox here. But and my soapbox is always a hit at all the cocktail parties here. I think inflation really, everybody's talking about where is it going to peak? 9.1% inflation, highest in 41 years. You could actually argue it's the highest inflation we've ever had over an extended period of time here in the U.S. because they've changed the way they calculate inflation over the years. So they do it differently today than they did back in the 70s and 80s. Like one big difference that's really changed the way the calculation works is they took out housing prices, right? We've had this huge housing run in across the country, right? Up over 20% in housing prices. But what they actually use today in the inflation calculation is rents. And rents are trailing housing prices in a big way. They're going up, but they're only up about 5 or 6% in the inflation calculation. So that's just a big difference between today's calculation and the way we saw it in the past. But really, and I think this is the story with inflation. You brought up the media as a good, I think it's a good point because it's a challenge in today's world. I think oftentimes you hear on the news, like inflation's caused by one or two things. It's really a host of different factors, right? A little bit of a perfect storm of a lot of things. Part of it's COVID, part of it's a lot of the money that the government put into the system to get through COVID. Some of it's supply chains, right? Some of it's Russia, Ukraine, right? You can go down the list. They're all contributing, but there's no single one element. Even the housing market is contributing, right? And that was something that's been building really since the global financial crisis over 10 years ago. We just haven't built homes like we normally did for the last 40, 50 years, right? When the housing bubble burst, you lost all those marginal home builders. And we just didn't build homes like we did really for the last 30 or 40 years. So there's a big supply-demand mismatch in the housing market. So, as far as inflation go, our view is I think this next month, we're going to see inflation come down, especially because energy prices have come down a little bit with the expectation that the economy is slowing. I think that's really why you've seen energy prices, oil prices, gas prices start to come down, because everybody's expecting, right, that the economy is starting to slow with higher interest rates. So I think that'll be embraced by the market. I think you'll see it in the August inflation number. It'll start to come down, and hopefully we'll see that trend hold for between now and year end. I think, energy is always a little bit of a wild card, but I think you'll start to see that play out between now and year end. Where it won't be 8 or 9% inflation by year end, but maybe it's 5 or 6 or 7, right? Which I think will feel much better, and it'll feel like the Federal Reserve, what they're doing is working, even though I'm not sure, right, it's an immediate reason why, but it'll look like, right, raising short-term interest rates has really slowed inflation, right? It'll be the trend more than the number going into 2023 that I think folks will be focused on, right? If it's starting to come down, they'll embrace that trend. That'll be good for stocks and bonds here in the near term, reverse out some of what we've seen happen so far this year.
So does you mentioned the housing shortage, like the inflation, interest rate, all of that ties to this like hope for investors, hoping that there's a decrease in housing pricing for the people that are like looking at buying and stuff like that. The fear of real estate, taking a dip like 2008, the supply shortage. Are you saying that you don't anticipate there being a drop substantially in real estate, but more of just a slowing in movement?
I think in certain areas you might see a little bit of a drop, but it won't be anything like we saw in 2008, 2009, right? When that housing bubble burst, right? A lot of people were extended buying homes that probably shouldn't have been able to buy homes, right? So it created a lot of bad loans in the market. You just don't see that distress, right? I think that the challenge is you still have this supply-demand imbalance, right? It's going to take more than a couple months and more than just higher interest rates to fix that. It'll probably take 3, 4, 5 years of higher interest rates and better supply in the market to get that balance back in line. But you could have certain areas. I'm in Arizona, and the prices here have been crazy over the last couple of years. So certainly areas like this that have been really hot could see prices come down a little bit, but I don't think to a distressed level where you'll see real estate come anywhere close to what we saw in 08, 09, right? So I think if you're waiting, right, for an opportunity, it might be slower to come than some folks are predicting. So we just don't see that. It's just too big of a supply-demand imbalance.
Cool. Thank you.
And moving on, I won't spend too much time here. A lot of numbers on this chart, but just wanted to highlight what's done well in the last couple bear markets, right? Just what parts of the market has done well. I think this is where, you can almost think about the bond market. Look at bonds normally are the hero in bear markets. That just hasn't been the case so far this year. I think there could be some catch up for bonds here, right? Where maybe we claw back some of the bond losses just based on the fact that bonds do recover, generally do better in bear markets. We just haven't seen that play out quite yet. I think this also highlights just how different the last two big bear markets have been, right? 2008, 2009 was all about the financial system, and you had some of that parts of the market really struggle, where 2000 to 2002 was all about the tech bubble. So they were just very different bear markets from what did well, what didn't do so well environment. So I think it looks a little bit more like 2000 to 2002, where I think you have some of the dividend paying stocks, dividend growers, some of those value parts of the market that are cheaper, that haven't done well in recent years, are holding up much better in the market. I think you'd expect to see that continue if stocks continue to struggle. And we did the same thing with the recession, right? We don't see the recession, but again, you can see normally bonds step up and deliver performance. You just look at bond returns in recession since 1972, pretty impressive. But again, the last couple of recessions have been pretty different from what did well and what didn't do so well. I thought it was just good to see how that's played out. Shifting gears back to bonds, beyond just the start of the year, we're coming up on 3 years now where it's the worst 3-year window of time for bonds ever in the 95 years of history. So speaking of historical outliers, this would be another great example where we've never seen a 3-year period for bonds in which you lost as much as we have over the last 3 years. And you've lost just under 1% for 3 years. You can see very rare for bonds ever to lose money over a 3-year stretch, right? These are, I think, what are they, 9-month ends in which you lost money in bonds over a 3-year stretch. So very rare if you hold bonds for 3 years that you lose money, but it has happened and happened recently. But you can see, look at the next 3 years for bonds here, pretty darn good returns. Granted, some of these periods, interest rates were much higher. So that 1980-81 period, when you were getting double-digit returns for bonds, that was all due to the fact that you had double-digit interest rates driving really high bond returns during those period of times. I think we look more like the 1957 periods here, right, where you had a really tough stretch for bonds over a 3-year window, but the next three-year windows of time here, you average between 4 and 5% on bonds per year over the next 3 years. So I think that's somewhat similar. We might not get to 5%, but if we do 3 to 4% in bonds going forward here, I think we'd all take that right at this point. Certainly add a lot of value to portfolios here in the near term. So thought that was encouraging, right? Just again, thinking about taking advantage of when the market pendulum swings too far. Just feels like this worst 3-year period ever for bonds is a sign that pendulum swung too far. And you've seen it as well. I won't spend too much time here, but we do watch where the money's going from a mutual fund and exchange traded fund flow standpoint. And we're going to have record outflows into bond funds. And that certainly is a signal that whenever everybody throws in the towel, that maybe it's a good time to put money to work there. So to me, just another sign that putting money to work into bonds at this point might be the right move. Because when investors start throwing in the towel, it's oftentimes good to go the other direction and embrace that historical outlier that we've seen. So just thought that was interesting. But I think I'm out of charts and graphs. Hopefully that was helpful. Think about really where we started, just how unusual it is to start the year where you have both stocks and bonds down as much as they are. Worst start ever for bonds, third worst start ever for stocks over the last 95 years. I think certainly bonds, that could create an opportunity here in the near term. Stocks, right, it's all about the volatility and the market trying to figure out where the economy is headed. We don't see the recession this year. We also don't think the Federal Reserve is going to raise short-term interest rates as much as the market's priced in. Again, I think that'll be a good thing for both stocks and bonds going forward. And I think, we touched on inflation. We do see it going down. I think that'll be a positive as well. The market will really embrace that in a big way. It's been a really big focus here in the near term. I think the bigger picture, longer term for inflation, right? It's not going to stay at 8 or 9%, but it's probably not going to go to 2% anytime soon either. So where it settles in there longer term, I think is the bigger question. But I think more important than ever, especially with those higher levels of inflation, more important to have a well thought out, well diversified portfolio built for today's market, right? If you're sitting in cash, you're losing out to inflation like you haven't lost out in over 70 years. Don't underestimate that reality. So lean on Ian and team for that diversified portfolio built for today's time. I just can't ring the bell on that enough, right? I see that across the country, right? Cash looks like a winner because it hasn't been down like stocks and bonds, but don't fall into that trap. I think it's an easy trap to fall into, especially now cash is earning a little bit of interest, but now's a better time to think about putting that money to work. So why don't I stop there, see if there's any other questions, thoughts, or comments out there. I'd love to hear what's on everybody's mind.
Yeah, a couple different things rolling through. One of the questions coming in, kind of comparing back to the 60s, 70s and past recoveries out of recession, depression time periods, how wartime spending has helped kind of rebolster economies during those windows of time, private defense contractors, drones, etc.
Sure.
Do you guys see any impact of that with kind of world events and political stuff going on right now?
Yeah, I think the challenge there is, right, we did do a lot of spending and stimulus during the COVID, right, which clearly contributed to some degree to the inflation challenge we're experiencing, right? It's just whenever you pump, they increased money supply by 40%, even a little bit higher over that period of time. So certainly not the only cause, but certainly a contributor to that higher inflation story. So it'd be hard to see them really ramping spending up in the near term, right, in a big way. I think maybe down the line that might work if the economy continues to slow. But you got to be sensitive to get that balance right, where you're still managing inflation, but not offsetting what the Federal Reserve is doing with higher interest rates. So sometimes, right, you don't want those fighting forces within the economy that can lead to some bad unintended outcomes. So, but it'll be interesting to see, right, to see how the economy absorbs some of these higher interest rates. If the economy is able to do that, right, maybe you don't have to worry about some of these higher spending initiatives.
Cool. Thank you. Another question that came through kind of separately from that is, what are your thoughts on the global shipping transportation exposure, ocean carriers, fuel prices to China lockdown, supply chain stuff?
Yeah, no, certainly supply chains are still a mess, right? I think if you talk to anybody in business building and manufacturing or really any type of, like you said, shipping business, their supply chains are still a mess. Tough to get things when you need them. Some areas are better, some are still struggling in a big way, but it's still kind of a mess. Probably takes right into next year to get it a little bit more ironed out. Some of the demand coming down with higher interest rates will help. So clearly that's going to continue to be a challenge. It's still, still creating pressure on inflation in the near term here. But hopefully it starts to get better into early next year, right? And helps that inflation level come down, where folks aren't challenged with those supply chains as drastically as they have been.
Thank you. Remember, if you want to ask a question, email amber@ricefg. We'll be on here for a few more minutes still. I do want to get your take, Mark. I tend to see that, like, in conversations, there's dirty words that like freak people out. And recession is one of those things. Can you speak a little bit to like the drastic nature of a recession versus a depression, and like, because like you see it and it's like, whoa, I should be super scared, as opposed to like the escalator kind of just tilted a little bit.
Right. Yep. That's a great point. I think, I think there's a lot of, especially, and you brought it up a little bit, I think the press is so much more polarized today, right? Where we have it, even with some of the best investors we work with across the country, right? They read something, they see something on TV. They're so much more likely to have that influence their investment thinking today than it was 29 years ago when I started in the industry. It just happened so much more. And you're right, recession is one of those dirty words, especially because we've had some pretty significant recessions, right? So you get that recency bias where, right, we think of recessions and you think of the global financial crisis, or even you think about the recession we had in March and April of 2020, where it was really short, but boy, was it severe, right? Down 30+% in GDP. So it was a very, very quick recovery, but it was still very significant and painful, right? With all the job losses we saw. We just don't see either scenario, right? We just think there's so much better and healthier footing for the economy, right? We talked about the employment picture being so much more positive, more cash on the sidelines, both at the consumer and at the corporate level. I just think there's a lot better footing for everybody heading into this recession, where we could have a recession. We could be in one now. Some people think, we don't think that's quite the case. It's going to be close, but we don't think that's the case. And it still could be pretty shallow, where technically it's a recession, but it doesn't feel nearly as dramatic, right, as what we saw in March of 2020, or even it's certainly not nearly as bad as 2008, 2009. And even not as bad as what we saw, right, in 2002, right, that tech bubble bursting 9/11 period, right, it was fairly significant. Wasn't as deep as the other two, but certainly lasted a while. So I think we're just in better shape at this point. There's no systematic challenges that we can see. Not that there still won't be some pain and some things to work out, but I just don't see the depth of the loss. And I think, right, again, that could be a positive for stocks going forward, right? If we've priced in a lot of slowing of the economy already, right? The market might be looking past a recession at this point.
So one of the things you mentioned earlier is that probability, I've seen this in a couple of different spots, but you said probability of recession in 2023 has increased a little bit based on current circumstances and data points. What do you think is leading to that? And what do you think we should keep in mind as we consider that time horizon for that?
Yeah, I think, as you move out, right, it's always tough to get much clarity, right? And especially in this environment where we have such dramatic swings in the economy with the shutdown and the restart. I think it's really kind of played tricks with some of the economic numbers. So having a lot of visibility is tough. I think this is the environment you need to stay a little bit. You always need to stay humble, right? In the markets, the market will humble you. But I think in this environment, right, you really need to stay humble. Given the fact that the clarity beyond really the first part of 2023 is tough to see. But I could see a scenario where it takes a while for the economy to really digest these higher interest rates, right? It takes a while for everybody to start slowing a lot of their activity in the economy, right? So I could see something where if you get some kind of shock next year, right, maybe that pushes you into a recession. But even at that point, we don't think it'd be too severe. But you could see an environment where, right, we avoid recession this year, but maybe that sets you up for some potential for another slowdown at some point next year, especially if you get another shock and something that we don't see, right? Whether that's inflation or, right, something that happens geopolitically, right? All those things could tip you into a recession. Or the Federal Reserve moves too far, too fast with interest rates. Certainly, that's possible as well.
Okay. And so probably similar thoughts. We had another question come through around relations with China related to Taiwan and stuff that's going on there and how that could affect our markets. Same type of concept.
Clearly. Yeah, I think that's, the geopolitical concerns, right? China and Taiwan, certainly a big one, right? Certainly the market won't like any type of turmoil like that. Certainly that could create other supply chain challenges, right? Just thinking, beyond the humanitarian challenge, right? Just thinking about it economically, right? Does that cause more ripples, more challenges in both energy and supply chains again? Kind of the Russia-Ukraine amplified probably with China and Taiwan, depending on how the rest of the world reacts. Certainly wouldn't probably react in any type of favorable way. But you can clearly see that. We've seen some of the challenges this year, right? That would be the type of event that could be challenging. Really tough to predict some of those geopolitical events, right? It's just tough to, certainly not my area of expertise, and always tough to crystal ball any of those predictions.
Right. So moral of the story on your end is you think we've had this extremely fast escalation of inflation, fuel prices, stuff like that. And that we should see them leveling-ish through the summer and starting to fall off on a fall-off trajectory forward, not like a cliff trajectory, but like a residual step back down over the next couple of years as things continue to kind of refigure themselves out.
Yeah, I think as long as we don't get a shock, right? Energy is always that wild card because you can have some big swings fast. Those geopolitical events can have a big impact. But if we keep energy kind of in this range where we've been here the last couple of weeks, I think that'll be a really positive backdrop, right, for inflation to come down. Energy is so powerful within that inflation number because really think about everything that we buy has some kind of energy component to it, right? Whether it's the delivery to get it there or the heating and cooling costs, right, to get it done. Just that energy component, just so pervasive in that inflation number, tends to, right, spider web through all the areas of that inflation calculation. So if you can get that under control, all of a sudden, right, I think that inflation story looks a little bit better.
Awesome. This is more of a strategy question, but curious. I'm sure you get different strategy questions as well. One of the questions came in with portfolios being down, the amount that they're down right now. Are the Roth conversions stuff that you see happening right now with folks being able to say, hey, it's down, convert a smaller amount and have it bounce back in another account? We saw a lot of that in 2020 with the bigger dip that we saw, like kind of right out of the gate. It was kind of this like quick blip. Do you see that happening right now, or is everybody
You
being?
know, that's probably not my area. I've seen a little bit, but it's probably not my sweet spot, right? Just from seeing folks do that from a planning standpoint. I can tell you one thing that I have seen, and this is probably in my 29 years, we're seeing people take some tax losses on their taxable bonds and even their municipal bonds, right? If they have some losses here over the last couple of years, right? This is probably the first time that we've had where you can take a meaningful loss in some of those bond funds, maybe reset them, you know, to different positions, realize that loss without any wash sale rules. I see that a ton. I've never seen as much as I've seen in the last handful of months here. And I think that makes a lot of sense, right? Make sure your plan's still intact, because remember, you know, we need to lean on that diversified portfolio as much as ever. But why not take advantage of some tax losses, make the accountant happy, bring that tax bill down? Makes a ton of sense to me at this point.
So from a BlackRock outlook standpoint, in a nutshell, right now, world events, all the stuff going on, it sounds like you have a expectation of continued volatility, probably just as much as we have currently through the rest of the year, because of the pace that we're on so far. But in general, you have a positive outlook for bonds and a positive outlook for stocks. And we may not get back to positive numbers, but you think we won't be in the same hole that we're in right now, kind of across the board.
I think it sets up well, right? I think, you know, normally, I think certainly on the bond side, I could see a pretty healthy rally there, especially, or even, you know, even if we just collected income, right? That would be a better return and recuperate some of those losses. Certainly on the stock side, right? I think the potential's there, especially if bonds do rally. I think stocks would rally a little bit just with interest rates finding kind of that ceiling. I think that would make stocks feel pretty good as well. I think, to your point, volatility is always, right? It's always easy to say we'll have volatility. It's all about the market trying to figure out where the economy's headed, right? So I think and I go back to that last slide when we looked at flows. I like to see when investors are throwing in the towel on bonds and selling out bonds like they have before. To me, that means that, right, maybe the worst is over for bonds, right? And it's a good time to put money to work. You haven't seen that same type of selling yet for stocks. But, you know, again, if that recession isn't real steep, this might be the biggest loss. So I think more opportunity in bonds in the short term. Longer term stocks, though, right? When the chart we looked at, you buy them when they're 20% off. It always works out pretty darn well over the long term.
Yeah, cool. I think that's most of the questions rolling through. I think a couple of things, obviously with strategy questions regarding taxes, this is compliance disclosure. You need to talk to your legal tax professionals and advisory team before you make tax decisions. We're not here to do that. We're here to help. And then obviously the market is unpredictable. And so, you know, there's always new things that come along. And so as we're looking towards the future, we appreciate your guys' insight, knowing that it's not guarantees, but just some really good analytic data. So we appreciate your time and effort and energy on that front. And the conversation today, I'm going to show one thing here. We do these webinars fairly often across the board on different topics, different things. So our selfish plug, if you want to learn about more events that we will be hosting coming up and keeping the loop on that, you can always email us or just go to the website under our events tab. So appreciate Mark, your time, Nicola, for helping get it all organized and coordinated. If I don't see any other questions. So I appreciate your guys' time, effort, energy going into getting ready for it. Look forward to
Thanks, everybody. Thank you.
Look forward to doing it again sometime.